everybody. My name is Teresa, and I welcome you to this new RankiaPro interview. And today we have the pleasure to talk with Giordano Lombardo, CIO, co-CIO, and founder of Plenisfer Investment. Hello, Giordano. How are you?
Hello, Teresa. I'm very well, and you?
It is a pleasure to be here with you. So, Giordano is the author of Plenisfer's annual letter, in which the firm's performance over the past year is reviewed and insights are offered on what 2026 will look like for markets. So, we will go through some of these insights together. Okay, so, Giordano, in your letter, you write that the most important development of last year was the loss of value of the United States dollar against all other currencies. Why do you believe the dollar's devaluation is still underappreciated or not fully priced by markets despite its broad effects on assets, capital flows, and returns?
Sure. I think the dollar weakness has been probably one, if not the most important, one of the most important development of last year financial assets trends. And this is due to the fact that a lot of investors are starting to realize that some of the US assets they've been relying upon in the last few years, starting from US large cap equities, are struggling to deliver the promised returns. I wouldn't say that this dollar weakness is fully under appreciated by investors, but I would say that the dollar weakness has a long way to go, also because it's linked to some structural forces that go against the dollar in the long term.
So, if we keep reading the letter, in the chapter of regime shift, you argue that it is highly unlikely that we return to the old environment of low inflation, low rates, and US led growth, suggesting that this era is likely over. What are the biggest mistakes investors risk making if they continue to allocate capital as if the old regime is still applied?
The biggest mistake is exactly to think that we are still in the old regime. Let me just explain what I mean by a new regime. We've been living for a long period of 2 or 3 decades in a situation in which low growth but also low inflation were very positive underlying trends, positive for the financial markets behavior, and also a relatively, let's say, uh, peaceful geopolitical environment, and also the peak of the globalization forces that meant that a lot of companies worldwide could benefit in terms of increasing productivity and profitability. Why do I believe this is over? I think there are a number of structural forces, not just on the geopolitical front, which is what we read in every day's news in terms of tensions that we are not used to, but also in terms of economic forces. The so-called deglobalization started well before the Trump administration started the trade war last year, and I believe this will have a negative impact in terms of overall productivity trends, growth trends at the global level. So we are in for more volatile markets, for a lower growth market, and probably for a resurgence of inflation that we are not used to. So we should adapt to a completely new regime in terms of investment, and adapt also our portfolios to that.
Thank you so much, Giordano. So you also said in your letter that the main macroeconomic risk, not priced by markets, it's a return of inflation to structurally higher levels, driven by deglobalization, demographics, and expansionary fiscal policy. If this risk materializes, which assets or market segments do you see as most vulnerable?
But first of all, a resurgence of inflation that, as we were saying before, is linked to this new regime change that we have in mind of deglobalization and increasing tension on both the economic and geopolitical front. These trends mean that we are in for higher interest rates, real interest rates environment. Also, the new investments in the technology area, the famous AI capex, so the expenditure by companies for the AI revolution are much more capital intensive than past technological revolution, which means that there is a pressure on real interest rates. And when real interest rates rise, all assets are repriced. So I think that we are going to have a repricing of all assets, equities, bonds, and also credit markets. Clearly, the immediate effect will be seen in particular on the government bond markets, especially in those markets in which the fiscal situation is particularly weak or weakening. And the three major examples that come to mind from that point of view are the US, in which the fiscal deficit is big and expanding, but also some European countries such as the United Kingdom and also France. So government bonds is an asset class that is going to suffer from the fiscal issue point of view. But as I said before, in terms of repricing, all assets will need to be repriced at a different level due to the higher level of interest rates.
So, in the AI chapter, you acknowledge we may still be in the early stages of a potential bubble. So, if AI falls to deliver expected returns, where do you think stress will appear first? In equities, credit markets, or private markets?
In presence of a bubble, we are. It's very difficult to say at which stage of the bubble we are, because a lot of money is coming into the tech sector, in particular into the AI capex expenditure, data centers, and semiconductor, everything related to the AI revolution. The AI revolution is something big, something that probably will transform our lives. So this is not to say that it's not something important, but it comes with some excesses. So from this point of view, the best example we had of something similar that happened in the past is the revolution of internet and the so-called TMT, telecom and computing revolution at the end of the 90s. Since that was a crisis, the subsequent crisis that, let's say, were mostly felt by the companies involved in that, we have seen that the first reaction, negative reaction was the most important negative reaction was the equity markets. This is very different, for example, from the 2008 revolution in which, the 2008 crisis in which instead the spark of the crisis started in the credit market, because that was a balance sheet crash. So I believe that even in this case, we are going to watch first and foremost at the equity markets, although even the credit markets and some segments of the private credit markets also will be touched by a potential explosion of the bubble, because burst of the bubble, because some of the expenditure in capex in AI are also funded through those type of instruments, so private credit and public credit.
Mm-hmm. Thank you, Giordano. We're going to continue talking about this bubble, this potential bubble, because in your letter, you argue, as you were saying, that today is much more similar to 1999 than 2008. So the question is, looking back at the dot-com bubble, which specific warning signs from 1999 should investors watch today to avoid repeating the same mistakes, especially, as you were saying, in a tech and AI-driven narrative environment?
Every bubble is different, so we are not saying that history will repeat exactly in the same way, but clearly there are a lot of reminiscences to the 99 2000 tech bubble, and these are mostly due to the overspending in the new technology. I think we all remember companies like Cisco, like Nokia, that were really the best companies at the time, which were involved, for example, in the infrastructure of the new telecom networks or the fiber optics, or in general everything that was related to putting together a new infrastructure for the new technology. This benefited the consumer. We all now can exchange videos in the or use videos on internet that are coming to us in a few seconds, while back then it was impossible. But clearly these companies are even not existing anymore or not important for investors. And I think the risk is exactly the same, that some of the companies now involved in the AI capex run, in the AI capex enthusiasm, can overextend their spending and will not be able in the future to get the returns coming from this expenditure. Some will win, some will lose, but overall the sector will mean that the return for the aggregate of the company will be either small or not enough to pay for the current spend.
Mhm. Thank you so much, Giordano. So this was actually our last question, and for RankiaPro, we want to thank you once again for being here with us. It has been a pleasure as usual.
Thank you, Teresa.
Thank you, and thanks to all of the investors that are watching as usual. Don't forget to share this interview and follow us on social media. See you next time.